When it comes to analyzing crypto prices, everyone talks about things like technical analysis, on-chain analysis, sentiment analysis, macro analysis, and so on and so on. But almost nobody talks about another factor that's arguably more important than all of these indicators, and that's the structure of the crypto market and how money flows through it. And that's why today we're going to tell you everything you need to know about the structure of the crypto market, including how it's changed, how it will change, and what it all means for your crypto portfolio. My name is Nick, and you're watching The Coin Bureau. First up though, nothing in this video is financial advice. It's purely educational content intended to inform you about the structure of the crypto market. If you want to get more content like this, then smash that like button, subscribe to the channel, and ping that notification bell. Now, once upon a time, crypto was difficult to buy, and there weren't many options to choose from. When Bitcoin launched in 2009, it was only possible to buy BTC peer-to-peer using online forums and marketplaces. It wasn't until 2010 that Mt. Gox, the first crypto exchange, was launched. Even then, it was hard to move money on and off exchanges since most banks refused to facilitate payments. In 2014, Tether solved crypto's banking problem by providing a solution, the USDT stablecoin. USDT basically made it possible for crypto exchanges to offer USD trading pairs for Bitcoin and other cryptos which began emerging around that time. USDT also made it possible for exchanges to minimize their reliance on banks since they could keep their money in USDT and exchange it more easily for US dollars. While USDT solved the banking problem for the crypto industry, it didn't solve the banking problem for crypto investors who continued to face hurdles when transferring money to and from exchanges. To use a personal example, one member of the Coin Bureau team had to go to a gas station to buy a special prepaid voucher so they could buy Litecoin from a crypto exchange in 2018 due to these banking restrictions. Oh, and he still wakes up screaming about that experience, by the way. Of course, these banking restrictions were not universal. It was much easier to cash in and out in countries with more progressive crypto policies, such as Switzerland, which began offering exchange-traded products, or ETPs, for the largest cryptos by the 2017 cycle. As a fun fact, the first ever crypto ETP was launched by CoinShares and listed on Sweden's stock exchange way back in 2015. Obviously, the listings of crypto ETPs made crypto more accessible to institutional investors, but it's important to note that institutional investment was and continues to be relatively low even with the recent launch of the spot crypto ETFs in the US. If you watched our recent video about who's been buying those spot ETFs, you'll know that around 80% of shares are held by retail investors. But back to 2017. The launch of multiple crypto ETPs globally and the CME's listing of Bitcoin futures significantly increased crypto's legitimacy as an asset class in the eyes of investors. Meanwhile, crypto exchanges committed to compliance like Gemini and Bitstamp made banks more comfortable facilitating payments to and from exchanges. Both structural changes made crypto much easier to buy. Fast forward to 2021 when money started flowing through the market structure in size. To put things into perspective, the total crypto market cap peaked at around $750 billion in 2017. In 2021, it peaked at around $3 trillion. And this was a massive increase, both in percentage terms and absolute terms. Although many believe this cycle won't grow as big in percentage terms, recent changes to market structure suggest otherwise. On the one end, you have the launch of various exchange-traded products, including spot Bitcoin and Ethereum ETFs, and in-house crypto offerings by major TradFi firms like Fidelity and BlackRock. On the other end, you have user-friendly wallets like Phantom, which make it easier than ever to buy and swap crypto. And you also have exchanges like Coinbase offering expanded access to tokens on chains like Base and Solana. When you consider that around 20% of investors in most developed countries hold crypto and around 60% hold stocks, you realize that the number of wealthy crypto investors could theoretically triple to match that of stocks. And when you remember how much crypto's market structure has changed over the last 2 years, you understand that the chances the total number of crypto investors will rise is high. You could go even further and argue that the inflow into the crypto market could triple relative to the prior cycle, assuming the same average inflows per investor. And this would mean a total crypto market cap of around $9 trillion for the current cycle, with a conservative top target of around $6 trillion. The drop in Bitcoin dominance since July suggests most of the remaining growth would come from altcoins. And if you want to make the most of what's coming, then you absolutely have to check out the Coin Bureau deals page. That's where you will find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges around. To get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click on the Sign Up Now buttons. These deals will not be around forever, so take advantage of them while you still can using the link in the description or scanning the QR code. Now, this pertains to the current cycle, which could peak later this year or early next year if history repeats. As we've learned, the structure of the crypto market is different than in prior cycles, and it's better in more ways than one. In other words, it is easier for money to flow in and out of the crypto market compared to prior cycles. But there are other changes to market structure that some say are worse. The first of these is the growth in the number of altcoins, which many believe has been draining liquidity. Besides the fact that this liquidity drain narrative assumes there's a limited amount of money in the crypto market, most of the altcoins created in recent years were meme coins launched by bots and traded primarily by bots. The growth in the number of quality altcoins has been much smaller, whereas CoinMarketCap tracks almost every crypto created. CoinGecko is much more selective in the coins and tokens it tracks. As such, you could say that CoinGecko does a better job of tracking the altcoins that real people actually trade. Back in 2021, the total number of altcoins tracked on CoinGecko was around 10,000. Today, it's around 19,000, so less than a 2 times growth over the last 4 years. Even though this growth in the number of altcoins has likely resulted in some dilution, it's not nearly as bad as many would make it out to be. More importantly, the new supply of altcoins is likely to be more than offset by the growth in demand coming from new investors, as we discussed earlier. And this ties into the second change that many believe has been worse for the crypto market, and that's the spot ETFs. In theory, the presence of spot Bitcoin and Ethereum ETFs means that capital rotation out of these ETFs into altcoins will be muted or entirely non-existent. Aside from the fact that there's nothing stopping the holders of these ETFs from simply selling them for fiat and using that fiat to buy altcoins, the rotation of capital from within crypto works very differently in practice than it does in theory. You see, most crypto whales don't rotate by selling BTC or ETH for altcoins. Instead, they rotate by borrowing against their BTC or ETH to buy that altcoin. This is for many reasons, but it's mainly for the fact that it allows them to keep their upside exposure to these assets and can also minimize taxes in some cases. In case you missed the news, banks like JP Morgan are now offering loans backed by spot crypto ETFs. What's interesting, though, is that most borrowing in crypto has been coming from DeFi. And if you watched our recent summary of Galaxy Digital State of Crypto Lending report, you'll know that DeFi lending has surged over the last year or so. Naturally, the most popular collateral for DeFi borrowing is ETH and BTC. So, what happens when the prices of ETH and BTC are pushed up by ETF inflows? Logically, there will be more borrowing against ETH and BTC in DeFi. In turn, this means there will be more crypto-native liquidity being created and flowing into the rest of the crypto market. Notably, most DeFi borrowing is done by borrowing USDC against ETH and BTC, and it is now easier than ever to move this USDC between chains thanks to Circle's CCTP and other interoperability solutions offered in DeFi. And this relates to the third change to crypto's market structure that many believe has made things worse, and that's the absence of stimulus checks or stimulus more broadly. As you might have guessed, this is yet another myth. Research by the Fed and other TradFi institutions found that most of the money from the stimmy checks went toward retail products and paying down debt. Almost none of it went into crypto. And the fact that retail investors have been buying stocks at record levels and speculating on options and penny stocks at volumes 2 to 3 times higher than in 2021 is empirical evidence that there's no shortage of money sloshing around. So retail investors seem keen to speculate, but the only thing missing right now is attention. So to recap, Yes, the total number of cryptos has doubled since 2021, but the number of new crypto investors and inflows is likely to increase by a similar amount. Yes, there's likely to be less direct rotation from ETFs into altcoins, but there are secondary effects that will increase on-chain liquidity, which benefits altcoins. But no, the evidence suggests stimmy checks are not required for crypto to rally. And this brings me to one aspect of crypto's market structure that is arguably inferior to prior cycles, and that's the factor I mentioned a few moments ago: attention. Literally everything about crypto's market structure has improved since the prior cycle, and this includes crypto's credibility as an asset class, the regulation of its platforms, the robustness of its protocols, and the ease at which capital can flow in. The only thing that has gotten worse is attention, which arguably peaked during the pandemic in 2020 and 2021. And that's just because the entire world was locked down, so people had to do things like learn about crypto. The result has been prolonged rallies in the crypto market, with clear-cut rotation between niches made possible by the fact that people had time to learn about all those altcoins. Put differently, it wasn't the stimmy checks that resulted in such an epic crypto bull market in 2021. It was the fact that people had more time to devote to crypto. And that includes learning about the crypto market, learning about all the different crypto niches, learning about all the individual altcoins within these niches, and learning about how to actually buy them. These days, people don't have that kind of time, and this means that crypto rallies in this cycle are likely to be shorter than 2021 and even be shorter than 2017, if you believe that attention spans have gotten worse over the years because of social media. If you need evidence of this, look no further than the last two crypto rallies in 2024. Both lasted for around 2 to 3 months, not because of a shortage of capital, but because of a shortage of attention. And if you need additional evidence that attention could be the limiting factor in this cycle, then look back to the 2017 cycle. As with the rallies in 2024, the rally in late 2017 also only lasted for around 2 to 3 months. And what's fascinating about the 2017 cycle is that the rotation between niches was much less clear-cut. Everything essentially rallied together. Despite this, dozens of altcoins experienced astronomical gains. So, unless there's a new pandemic or something similar that results in people having extra time to learn about crypto, chances are the current rally will be more like the 2017 cycle than the 2021 in terms of the length of the rally and the scope of the rotation. Again, the rallies from 2024 suggest that this is the case already, and it means we need to be cognizant of which cryptos will get attention and how long they will rally for. Thankfully, it's pretty easy to figure this out because the price action is typically what causes people to start paying attention. First, an altcoin starts pumping, and this causes people to start paying attention. If the narrative is strong, then maybe they'll allocate a bit, and this causes prices to go higher. The stronger the narrative, the more they will allocate, the more prices will go up, the more attention comes, and so on and so on. But recall that crypto market structure is the most important factor when it comes to a crypto's price potential. If the coin or token in question isn't easily accessible, then it doesn't matter how much it's pumping or how strong its narrative is or how much attention it's getting. If it's too hard for most people to buy, then the pump will probably be short-lived and the attention will quickly fade and go elsewhere. And FYI, the most accessible cryptos are the ones that have been around the longest, like Litecoin and XRP, and the ones that exist on fast, low-cost blockchains that have user-friendly front ends like Solana and Base, which have Phantom and Coinbase respectively. If the crypto you hold falls into one of these two buckets, then it has a higher chance of getting attention compared to the other cryptos that don't. Now that you have a better understanding of the structure of the crypto market and how it could affect the current cycle, let's wrap things up by looking at how crypto's market structure could change between now and the next cycle, which will likely occur sometime in 2029. At first glance, you might think it's too early to assess this, but upon closer inspection, you realize these changes are already underway. The two big talking points here are the Genius Act, which recently became law, and the Clarity Act, which could soon become law. Now, to quickly recap, the Genius Act provides clear regulation for stablecoins issued in the US, whereas the Clarity Act will provide clear regulation for everything else in the crypto in the US. It's extremely important to note that both will only go into force sometime in 2027, and this means that right now, These regulations being passed merely act as bullish catalysts for the crypto market. They have not changed the market structure yet, but they will in the coming years. Not surprisingly, everyone in crypto assumes that these regulations will be bullish after they go into force. What's surprising, though, is how wrong these assumptions could be. They could be bearish for most cryptos. You see, what the Genius Act and the Clarity Act will do is allow TradFi to get more involved in crypto. Perhaps we're mistaken, but it's a bit naive to think that most crypto projects and companies can compete with TradFi firms when they're put on the same level playing field. For all their faults, TradFi firms have more financial resources, they have more manpower, and they have more public trust. So, suppose that mega banks in the US like JP Morgan or Bank of America launch a shared stablecoin on a crypto blockchain like Ethereum in the coming months. Now suppose that the crypto market experiences a massive crash during the next bear market that causes panic, which is likely. How much capital do you think would flow out of stablecoins like USDT and USDC into the mega bank stablecoin? We reckon it will be quite a bit, especially if crypto investors start to question the stability of stablecoin issuers like Tether and Circle. Not only that, but it's easy to forget just how much more accessible a banker stablecoin would be compared to a crypto stablecoin. Chances are they would make it possible to mint and redeem their stablecoin from directly within millions of bank accounts. Now, for context, only select institutions can mint and redeem USDT at Tether or USDC at Circle. If banks start launching their own stablecoins that offer easier issuance and redemption, the supply of these stablecoins would eventually outpace USDT and USDC because of the structural difference. That said, whether this happens before the next crypto cycle remains to be seen, and it's unlikely to happen soon. However, the same can't be said for TradFi firms looking to take advantage of all the other crypto niches the Clarity Act will unlock, namely tokenized real-world assets, or RWAs. In short, it's likely that TradFi firms, like exchanges, will start offering tokenized RWAs to their clients. Recent changes proposed by the CFTC and SEC also foreshadow TradFi exchanges offering crypto trading and futures, just like crypto exchanges. The TradFi exchanges that come to mind here is the NASDAQ, which is looking for SEC approval to offer tokenized RWAs and recently invested in Gemini to offer crypto products and services to its clients. What are the chances that TradFi exchanges like NASDAQ start acquiring crypto companies like exchanges during the next crypto bear market, or even start hiring the top talent from these crypto companies? It's worth pointing out that this isn't speculation. We've already seen many TradFi firms acquire crypto startups to launch their own crypto-related products and services, including Stripe and Robinhood. It's not far-fetched to assert that TradFi firms will take advantage of the inevitable bear market to try and acquire as much of crypto's infrastructure as possible so that they can be the beneficiaries of the next cycle. In fact, with each passing day, it looks more and more likely that this will happen. Today, most people trade crypto on exchanges like Binance, using stablecoins like USDT. In the next cycle, most people could be trading crypto on exchanges like the NASDAQ, using a shared stablecoin issued by a megabank. In this sense, you could say that the next cycle will be a digital asset cycle rather than a crypto cycle. The bad news is that the change in the crypto market structure could result in most cryptos dying off for good, since many of the crypto exchanges that offer them could just disappear. The good news is that dozens, if not hundreds of cryptos will still be around, and there will probably be entirely new asset classes to speculate on, like tokenized RWAs launched by startups that are eerily similar to altcoins. For what it's worth, we'll still be here, doing our best to identify the changing structure of the crypto market and explain what it could mean for the markets. And if you appreciate that, then smash that like button and subscribe to the channel and ping the notification bell so you don't miss our next video. Until then, be sure to check out our video about when the crypto market cycle could top, using the link right over here. Thank you very much for watching, and I'll see you guys again soon. This is Nick, over and out.